Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into the Crypto Market Structure Bill, which encompasses the Clarity Act and the Genius Act.
And this one is fascinating because it immediately lays out the central conflict. The Clarity Act and Genius Act create a graduation framework for digital assets to transition from SEC securities to CFTC commodities, what some are calling the workforce phase.
There's a big but.
A very big but. Their enactment is completely stalled by a four-sided Senate negotiation deadlock over things like ethics clauses and anti-money laundering controls.
So for any investor out there seeking some kind of certainty in a market that's really just been defined by regulation, by enforcement, this deep dive is your essential roadmap.
It is. This decade of legal uncertainty has been a major drag on the industry.
Okay, so that is the perfect setup. We have this potentially transformative solution on one side, and on the other, this intense political friction keeping everything in limbo. Let's unpack the solution first. You mentioned the Clarity Act is meant to replace regulation by enforcement.
Exactly. That old approach, relying on the 1946 Howey test for every new token just doesn't fit.
It's created so much confusion.
Right. So the Clarity Act tries to end that. It codifies a clear three-tiered classification: digital commodities, investment contract assets, and permitted payment stablecoins.
And the real genius here, I think, is the movement between those tiers.
Yeah.
It recognizes that a token status shouldn't be permanent, right?
Precisely. That's why everyone is calling it a graduation framework. An asset starts its life as an investment contract asset.
So under the SEC's jurisdiction.
Under the SEC, yes, during its fundraising phase. Think of an ICO or early VC rounds. The issuer has to comply with all the usual SEC registration and disclosure rules.
So the SEC is in charge when the asset looks most like a traditional investment in a startup. But the whole point of these things is to eventually become decentralized networks. So when does the SEC step back? When does it graduate?
Well, the transition is tied to two triggers, and they're both focused on decentralization. An asset becomes a pure digital commodity and sheds its security label in one of two ways.
Okay.
First, if it's sold in a secondary market transaction by someone who is not the issuer, that signals real market activity. Or second, and this is the big one for projects, when the underlying blockchain is certified as a mature blockchain system.
And that word mature, that's the key to everything. What are the actual metrics for that? How do they define it?
The criteria are quite strict. It's really about separating genuine networks from centralized corporate projects in a crypto wrapper. The system has to be functional, open source, and run on transparent rules.
And the most important one?
The single most important metric is the 20% control threshold. The issuer, or anyone related to them, cannot control 20% or more of the total tokens.
Wow. That is a massive operational detail. I mean, if you look at a lot of existing protocols, they would struggle with that 20% rule. They'd be stuck as securities until they genuinely give up control.
It forces their hand, rapid decentralization or permanent SEC compliance. And the implication of graduating is enormous. Once it's certified as a digital commodity, the jurisdictional fight is over.
And the winner is?
The CFTC gains exclusive jurisdiction over anti-fraud and anti-manipulation in the cash market, the spot market. That is the structural certainty the industry has been begging for.
Okay, so that's clarity for the tokens themselves.
Yeah.
But what about the digital cash, the stablecoins? That's where the Genius Act comes in, right?
Right. The Genius Act focuses on regulating what they call permitted payment stablecoins. The goal is to create a secure, regulated lane for them to operate in the U.S. instead of having this massive payment rail exist completely offshore.
And this act brings some serious C-suite accountability into crypto. This is where traditional finance rules come roaring in.
Absolutely. The requirements are tough. Issuers have to file detailed monthly reports, and those reports have to be examined by a registered public accounting firm.
And it's not just a slap on the wrist if they get it wrong. We're talking about criminal consequences here.
We are. The act is explicit. CEOs and CFOs are subject to criminal liability for falsely certifying those monthly reports. It mirrors the penalties under Sarbanes-Oxley. Your personal freedom is on the line.
It also locks in the separation of banking and commerce, which feels like a huge structural guardrail.
A critical one. It prohibits non-financial companies, big tech or retail giants, from controlling a stablecoin issuer.
So no Amazon coin that becomes a private, unregulated currency for one company's empire.
That's clearly the intent, and analysts are saying this level of clarity is the green light institutions have been waiting for. The projection is that the stablecoin market cap could double within a year of this passing.
That's a serious expectation.
Yeah.
And you saw that optimism in the House. The Clarity Act passed on July 17, 2025, with a huge bipartisan vote, 294134.
Which signals a really broad consensus. This isn't just a niche political issue anymore. It's seen as a legislative necessity.
And yet, despite all that momentum, we're stuck. As of right now, December 2025, the bill is stalled in the Senate Banking Committee.
Yeah, the gears are just grinding to a halt. Key deadlines are slipping. Everyone now expects this to be delayed until at least January 2026.
Now, before we get into why it's stalled, there's one area of huge agreement that's already in the bill, and that's the anti-surveillance part.
Indeed. Title VI is literally called the Anti-CBDC Surveillance State Act. It explicitly prohibits the Fed from issuing a central bank digital currency directly to individuals.
So that has locked in a lot of support from both sides, right?
Yeah.
People concerned about government overreach and privacy.
Absolutely. It effectively guarantees the U.S. stablecoin system will be a private sector-led endeavor.
Okay, so let's get into the deadlock. If everyone agrees on CFTC oversight and no surveillance state CBDC, what are the 4 specific hurdles causing this delay? These are the real risks for investors.
Well, the negotiations are touching on some really sensitive issues now.
First up, ethics clauses.
This one is intensely political. There's a strong push for ethics clauses that would prevent government officials and their families, with President Trump being mentioned specifically from profiting from digital assets. The White House has already pushed back hard on that.
So, a political minefield. Risk 2, stricter AML controls.
Right. Democrats are pushing for much stronger anti-money laundering provisions. They're concerned about DeFi platforms being exploited and want to see robust Bank Secrecy Act requirements, especially for unhosted wallets.
Then there's risk number 3, which is a direct threat to the traditional financial system. Banking fears.
A huge one. Community banks in particular are worried that interest-bearing stablecoins could just drain their deposits.
So people would pull their cash out of local banks to chase yield on a stablecoin.
Exactly. And that would hurt the bank's ability to make local loans. It's a real clash between crypto innovation and the existing financial architecture.
And the 4th risk is kind of a surprise. It's external opposition from a group you wouldn't expect.
That's the lobbying from the American Federation of Teachers, AFT. They're worried that if the regulations are too loose, it could destabilize the broader markets and put their pension funds, which rely on secure capital markets, at risk.
And to make it all even more complicated, there's a competing bill floating around.
Yes, the Senate Banking Committee released its own draft, the Responsible Financial Innovation Act, or RFIA, and it really muddies the waters.
How so?
The RFIA draft focuses more heavily on the SEC retaining authority over what it calls ancillary assets. It would give the SEC much more discretion, potentially creating a conflicting regime to the very clear commodity pathway in the Clarity Act. The uncertainty would just continue.
So this all brings us back to the critical question for anyone trying to invest in this space.
Mm-hmm.
Does that strong consensus on CFTC oversight and no CBDC guarantee this thing eventually gets done? Or will the competing RFIA draft and this four-sided political deadlock just keep the markets stuck in this legal gray zone?
I think the synthesized verdict is clear but volatile. You have undeniably high institutional conviction. The money is flowing in through ETFs, which suggests the market expects a positive outcome. But the legislative environment itself is the single biggest systemic risk right now.
So until those 4 sticking points are resolved.
Until the Senate can figure out the ethics rules, the AML controls, the fears from community banks, and which bill they're even working from. Market participants just have to keep navigating this uncertainty, always with the threat of random enforcement hanging over their heads. The policy might be sound, but the politics are driving the risk.
Risk defined. Portfolio protected.